Okay, we're going to start a new chapter. This is going to be Kimmel 7th edition, Chapter 6, Inventories. 3 or 4 major learning objectives that we'll talk about in a second. But here's the bad news, okay? The bad news is that if you like journal entries, there's no journal entries in this chapter. So it's just a matter of calculating inventories and ratios, understanding how to calculate cost of goods sold, ending inventory under various cost flow assumptions. So let me share my screen. We can start this PowerPoint presentation. So this is accounting tools for making decision-making, 7th edition Kimmel, and specifically reporting and analyzing inventory. So we have some learning objectives. Let's talk about that. Discuss how to classify and determine inventory. Apply inventory cost flow methods and discuss their financial effects, specifically the effect on net income and the balance sheet. Explain the statement presentation and analysis of inventory. Learning objective 1, discuss how to classify inventory and determine inventory. So we need to think about a couple of concepts here, types of companies that we're looking at. First type of company is a merchandising company. We just had a whole chapter on merchandising companies. And simply put, a merchandising company is one that buys a finished product and sells it to the customer. Examples are like Target and Walmart. They buy a product that's already completed, put it on the shelf, and sell it to their customer. Inventory valuations, generally, the general rule is inventory is at cost. Now, the other type of company is a manufacturing company. Now, we're not going to talk about manufacturing companies in financial accounting. For those of you who move along to managerial accounting primarily covers manufacturing companies, companies that make stuff and then sell it. Make stuff from raw materials, untouched materials. If a company is a furniture store, for a furniture manufacturer, that is, they purchase wood, hardware, nails, glue, glass, paint, and they cut the wood, sand the wood, paint the wood, nail the wood, put things together. So that is a manufacturing company. They make something and then sell the product. Now, inventory needs to be broken down into 3 major categories. Raw materials, which are essentially untouched materials. Work in process is exactly that, something that is started but incomplete. And the 3rd category of inventory is finished goods, completed product, ready for sale. Determining inventory quantities. A physical inventory is taken for 2 reasons under each system. In a perpetual system, we talked about that during the last chapter, a perpetual system, where they always know the value of inventory, at least in the computer. So they want to take a physical count and they want to compare it. They check the accuracy of inventory records. So there is a comparison between what the computer says they have on hand and what is physically on hand. They want to make sure it's accurate and make adjustments. Determine the amount of inventory lost due to wasted raw materials, shoplifting, employee theft. Under a periodic system, that means you only calculate inventory at usually the end of a month or end of a year. They want to periodically determine the inventory on hand and determine the cost of goods sold for that period. Taking a physical inventory involves counting, weighing, or measuring each kind of inventory on hand. It's performed when the business is closed or business is slow at the end of an accounting period. So physically, they go to the aisle and they look on the shelf and say, well, how many Bose speakers do we have? So they count them and say, we got 5 of those physically on hand in the store. And then they go into the computer and say, well, how many does the computer say we have? Well, the computer says there's 6. I could only find 5. What happened to the other one? Was it a computer mistake, input error? Was it stolen? Was it damaged? Is it in another part of the store? So physical inventory is important for that very reason. Determining ownership of goods. So we're going to spend a little bit of time here. We're going to see a problem later on when does the company own? When does the company own the inventory? Goods in transit. Purchase goods that are not yet received. So it may not be physically there, but do they own them? Do they not own them? Depends. Sold goods that are not yet delivered. So just because the inventory is not in the warehouse doesn't mean we don't own it. We may own it, depending upon the terms of shipment. Goods in transit should be included in the inventory of the company that has legal title to the goods. Legal title is determined by the terms of the sale. Let's look at some examples. And we saw this before when we talked about freight costs. FOB shipping point. Ownership of the goods passes to the buyer when the public carrier accepts the goods from the seller. FOB shipping point, okay? Versus FOB destination. Ownership of the goods remains with the seller until the goods reach the buyer. So we need to know, we need to remember those terms when it comes to determining ownership. Here's a question for you. Goods in transit should be included in the inventory of the buyer when the public carrier accepts the goods from the seller. Goods reach the buyer. Terms of sale are FOB destination. Terms of the sale are FOB shipping point. Remember the question, goods in transit should be included in the inventory of the buyer when terms of the sale FOB shipping point. Consigned goods. What are consigned goods? Goods held that are owned by other parties. So they may physically have that product in their store, but it's owned by somebody else. The consignee tries to sell the goods for the consignor, who's the owner, for a fee without taking ownership of the goods. Many car, boat, and antique dealers sell goods on consignment. Why? So they don't have to spend the money for the inventory. They hold it in the store. It's owned by somebody else. They didn't have to pay for it, but they take a fee when it's eventually sold. So the rules of ownership. Has been company completed its inventory count. It arrived at the total inventory value of $200,000. You have been given the information listed below. Discuss how this information affects the reported cost of inventory. So you're starting with $200,000. The question is, do we need to make some adjustments? So has been included in inventory goods held on assignment for falls company costing $15,000. So has been included it, but it's owned by somebody else. So it doesn't belong there. And so we'll go back and look at this. So that $15,000 is not going to belong there. Number two, the company did not include in the count purchased goods of $10,000, which were in transit, terms FOB shipping point. So they bought something for $10,000. It's not in their warehouse yet, it's in transit, but they purchased it FOB shipping point. They took ownership when it was, when the carrier picked it up. It should be included in inventory. Number three, the company did not include in the inventory count that had been sold with a cost of $12,000, which was in transit, terms FOB shipping point. So they did not include it, but it was sold FOB shipping point. It was in transit, so they don't own it, so they did it correctly. Let's look at their solution. Goods of $15,000 held on a company should be deducted. They don't own it. Number two, the goods of $10,000 purchased FOB shipping should be added to the inventory count because it was FOB shipping point. And third, the item 3 was treated correctly. So the adjusted inventory is 195. Apply inventory cost flow assumption methods and discuss their financial impact. This is the big aspect. This is the major component of this chapter. So inventory methods and financial effects. Inventory is accounted for at cost. Cost includes all expenditures necessary to acquire goods and place them in a condition ready for sale. Unit costs are applied to quantities to determine the total cost of inventory and cost of goods sold using the following costing methods. So here's a cost flow assumption. So we have to assume that, so if we continue to buy the same finished goods from a supplier, we have purchases at different times. If the cost is the same all the time, then it's irrelevant. But there are times when the cost fluctuates. Purchase at the beginning of the month might be $10. Purchase at the middle of the month might be $11. Purchase at the end of the month is $12. So what is the cost of what we sold? Well, it depends on the flow. We don't know what the actual flow is, but we have to make an assumption. Those flows are, well, we have specific identification. We can specifically identify what's being sold. The second method is a first in, first out. And again, it's an assumption. The first product that came in, the first one that went out. The third assumption is last in, first out. And then the last one is average cost. The cost flow assumption that we take on is going to have an impact on the cost of goods sold. Therefore, we may have a different net income depending upon the cost flow assumption. Here's what a specific identification looks like. An actual physical flow costing method in which items still in inventory are specifically costed to arrive at the total cost of the ending inventory. In practice, it's relatively rare. Most companies make an assumption. The only time specific identification works is with large valued items that don't move very often. Cars, boats, houses. Okay? Small items that have high volume doesn't work. Specific identification. Here's an example. Illustration. TV company purchases 3 identical 50-inch TVs on different dates at costs of $700, $750, and $800. During the year, they sold 2 TVs at $1,200 each. So we know what the revenue is going to be. 2 at $1,200, $2,400. But which TVs did they sell? It's going to impact what our gross profit is. Remember gross profit? Sales revenue minus cost of goods sold. We know the sales revenue here is $2,400, but which 2 TVs did they sell totaled up to what number of cost of goods sold? So they sold the TVs it purchased on February 3rd and May 22nd. So if we go back, the cost of the one on the 3rd was $700. The cost on the 22nd was $800. So obviously, cost of goods sold is $1,500. Ending inventory is $750. So again, let's look back here. So we have 3 items. We know specifically which ones we sold. We sold the 3rd and the 22nd. Again, cost of goods sold is $1,500. The value that's left over, that's still in inventory, is that one from March 5th at $750. So we need to know 2 things. What is the cost of goods sold and what is ending inventory? And under specific ID, we can do that. Again, we only have 3 items, so it's pretty easy to figure out. So data for the cost flow assumption. So here's an illustration we're going to use. And here is the history of what they purchased. So they had a beginning inventory. They started with 100 units, and the cost of those 100 units was $10 a unit. On April 15th, they bought another 200 units. You can see the price change. It's $11. On August 4th, they purchased another 300 for $12. And on November 27th, they purchased another 400 at $13. So the total units available for sale were 1,000. The units in ending inventory were 450, so they had 450 left over, but they sold 550. So the question is, what is the cost of the units sold? Well, it depends, because we have a fluctuating unit cost, we have to make an assumption of what was sold in order to calculate the cost of goods sold. Were they the ones at $10, the ones at $11, the one at $12, the one at $13? Which ones did they sell? Because let's remember the formula: begin inventory plus the cost of goods purchased less ending inventory equals the cost of goods sold. Nature of the first in, first out, okay? Cost of the earliest goods purchased are the first to be recognized in determining the cost of goods sold. Again, first in, first out. So the first items that we had were the first ones to go out. So the cost of goods sold is made up of the first ones. And the ending inventory is made up of the ones that were purchased most recently. What are they saying here? It says this often parallels actual physical flow of merchandise. Companies determine units and costs of ending inventory starting with the unit cost of the most recent purchase and working backward until all units of inventory have been costed. So let's look at this example. So remember, number of units available were 1,000, beginning inventory plus what was purchased. So what was available was 1,000. And they told us that the ending inventory was 450, so 450 units. So remember, first in, first out, that means the ending inventory is made up of the most recent purchases. So if we got 450, and you can see in the lower left-hand corner of this slide, we have to account for the cost of 450 units. So that layer, if you will, from November 27th was 400 units. So 400 units are valued at $13 for 5,200. But remember, there's 450 units in ending inventory. So I need another 50. So I had to go into that next layer, the August 24th layer. And there's 300 units there, but I only need 50 of them to get to my total of 450. So 50 at 12 is $600. So ending inventory is $5,800. And they said the goods available for sale, right? Beginning inventory plus all the purchases was $12,000. You just determined ending inventory to be $5,800. Therefore, the cost of goods sold is $6,200 under FIFO. And here's the illustration of it, making up the $6,200. What about last in, first out? Costs of the latest goods purchased are the first to be recognized in determining the cost of goods sold. So here, last in, first out, the most recently purchased ones are assumed to be sold, and ending inventory is made up of the older stuff. This seldom coincides with actual physical flow of merchandise. Exceptions include goods stored in piles, such as coal or hay. So again, the same purchase data, right? Beginning inventory, 100 units, and they purchased 900 units throughout the course of the year here. So they have goods available, 1,000. So again, they sold 550. They got 450 in ending inventory. So if there's 450 in ending inventory, which ones are there? So last in, first out. So that means the ending inventory is made up of the oldest stuff. So I need 450 units. I go to that very first layer, the beginning inventory, there's 100 there at $10 for 1,000. I got to get the 450. Go to the second layer on April 15th. There's 200 units there at 11. So I've accounted for 300. I still need 150 more. So I got to go to that August 24th layer and take only 150 there at $12 for 1,800. So the ending inventory totals to be $5,000. Cost of goods sold calculation. Cost of goods available for sale, the same $12,000, less ending inventory, which you just calculated to be $5,000. Cost of goods sold is $7,000. Third assumption, average cost. Allocates cost of goods available for sale on the basis of weighted average unit costs incurred. Applies weighted average unit cost to units on hand to determine the cost of ending inventory. So what we do here is, again, this is the same purchase data that we've worked on all three of these things. 1,000 units are available for $12,000. Average cost, take the total cost divided by the number of units. $12,000 divided by 1,000 units, the average weighted cost is $12 per unit. Ending inventory is simple to calculate. As long as I know the number of units in ending inventory, I got 450 units in ending inventory, $12 a unit. Ending inventory is valued at $5,400. Cost of goods available for sale, $12,000, minus the ending inventory of $5,400. Cost of goods sold, $6,600. Cost flow assumption. The cost flow assumption used does not need to be consistent with the physical movement. This is telling you, again, this is an adoption of a method used by US companies, right? 45% of companies use FIFO, first in, first out. Now, this is what's really interesting, because the sales revenue doesn't change, but you can see, because the cost of goods sold is different under each of the scenarios, the net income is different. So the cost of goods sold under FIFO was $6,200. The cost of goods sold under LIFO, $7,000. Cost of goods sold under average cost was $6,600. So that's the only number that changes. So you can see net income is different depending upon which cost flow assumption you're going to use. Income statement effects. In periods of inflation, the cost flow assumption can have a significant impact both on income and on evaluations of net income. FIFO produces the higher net income because lower unit costs of the first items purchased are matched against revenue. And LIFO produces the lower net income because higher unit costs are last goods purchased. So under FIFO, right, first in, first out, cost of goods sold is made up of the oldest stuff, the lower price stuff, therefore net income is higher. Under LIFO, cost of goods sold, last in, first out. In an inflationary period, cost of goods sold is made up of the higher per unit items, therefore net income is lower. Skip that one. So here's a question. But the cost flow method that often parallels the actual physical flow of merchandise is which one? It's FIFO, right? First in, first out. Next question. In a period of inflation, the cost flow method that results in the lowest income and taxes is what? It's going to be LIFO. I just said that, right? Because cost of goods sold is made up of the more recently purchased items. US inventory cost flow methods, consistently. Methods should be used consistently. Once you adopt the method, you have to stay with it. Can't change it. So here's an example. The accounting records of Shumei show the following data. Beginning inventory, 4,000 units at $3 a unit. Purchases, 6,000 units at $4, and they sold 7,000 units. The sales price was $12. So they had goods available for sale of 4 plus 6. They had 10,000 units available for sale. They sold 7,000. But what was the cost of those 7,000? It depends on the cost flow assumption. So determine the cost of goods sold during the period under a periodic system using FIFO. So goods available for sale, you got to do all that math, right? 4,000 times 3 is 12,000. And then you've got 6,000 at 4, that's another 24,000. So goods available for sale with $36,000 minus ending inventory. So remember, FIFO, first in, first out. They sold 7,000. There's 3,000 in ending inventory. So 3,000 at $4, first in, first out. So the 3,000 in ending inventory are the most recent purchases at the $4 level. So goods available for sale, 36,000. Ending inventory is 3,000 times 4 or 12,000. Cost of goods sold is 24,000. Under LIFO, again, the cost of goods available for sale with 36,000, right? 4,000 times 3 plus 6,000 times 4 is 36,000. LIFO, last in, first out. The units sold were the most recent layer. And ending inventory is made up of the original layers. So we have 3,000 in inventory at the $3 for $9,000. Ending inventory is $9,000. 36 minus 9, cost of goods sold, 27,000. Under average cost. Under average cost, what's the answer? So we had $36,000 of purchases divided by 10,000 units that were purchased. The average cost is $3.60 per unit. Ending inventory is still made up of only 3,000 units at $3.60. Cost of goods sold is $25,200. Objective number 3, explain the statement presentation and analysis of inventory. Inventory is classified on the balance sheet as a current asset immediately below receivables, right? Cash, accounts receivable, inventory. And a multi-step income statement, cost of goods sold is subtracted from net sales, right? Net sales minus cost of goods sold equals gross profit. Disclosure is required of what? Major inventory classifications: raw materials, work in process, finished goods. You also need to disclose the basis of the accounting, cost or lower of cost or net realizable value, whichever one. And then you have to specifically tell the reader what is the cost flow assumption that you're using to value ending inventory and cost of goods sold. Is it FIFO, LIFO, or weighted average? Here's an example of a footnote, which we're not going to discuss. Let's talk a little bit about the lower of cost or net realizable value. When the value of inventory is lower than cost. So let's think about it. They may have some inventory in their warehouse. Maybe it's been there a while. Maybe they paid $100 per unit for it. But if it's sitting in the warehouse for a while, does anybody want it? What does it say about its value? Maybe it's obsolete. Maybe nobody wants it. Maybe it's, it's just not what is up to speed anymore. So the question is, how should it be valued? Companies must write down inventory to its net realizable value in the period in which the price decline occurs. This is an example of conservatism. Net realizable value is the amount a company expects to realize from the sale of the inventory. Again, remember, we're going to state this inventory at the lower of cost or net realizable value. And net realizable value is determined, as far as we're concerned, as what they expect to realize from the sale of the inventory. When the value of inventory is lower than cost, applied to items in inventory, applied to items in inventory after the company has used one of the cost flow assumptions. Companies that use LIFO or retail inventory method are not required to use lower of cost and net realizable value. So here's an example. Here's an illustration of Ken TV has the following lines of merchandise with costs and market values as indicated. So the flat screen TVs, they've got 100 of them. Cost per unit, $600. Net realizable value, $550. So when we value the inventory, we're going to use the $550 because that's the net realizable value. When we look at satellite radios, they got 500 of them. The cost is $90, net realizable value is $104. We're going to use cost because cost is lower. The DVDs, they've got 850 of them. You can see the net realizable value is less than cost. We use the lower of, use the $48. And then lastly, they've got 3,000 DVDs. The cost is $5, net realizable value is $6. You're going to stay with the cost, lower of, at $5. And now inventory management is a critical task because high inventory levels lead to storage costs, interest costs. So the question is, how much inventory do you want to have? You want to have just enough. You don't want to have too little, but you want to have just enough because it costs money to carry inventory. So here's a couple of ratios that I need you to be familiar with. Inventory turnover. How many times does inventory turn over in the cost of the year? That's going to be the cost of goods sold divided by average inventory, right? Average inventory, beginning plus ending divided by 2. And then how many days was that item in inventory? You take the number of days in the year, 365, divided by the inventory turnover ratio you just calculated. Here's an example. You've got Walmart, you've got their inventory, beginning and ending, right? Beginning is 2015, 44,469. 2016, 43,000. Cost of goods sold, 361,000. So you can see that the inventory turnover in 2016, cost of goods sold divided by average inventory, beginning plus ending, divided by 2. Their inventory turns over 8.3 times. In 2015, it turned over 8.1 times. And they show a comparison, a rival company, Target, turned over 5.8 times. So Walmart is turning their inventory more often, which is a good thing. The more times you turn over your inventory, the more money you make in theory. Look at the number of days it was in inventory. In Walmart, it was there for 2016 for 44 days. 2015, 45 days. So they're getting better. Look at Target. 62 days on average it took to sell something. Walmart's doing better than Target. And that's it for the PowerPoint presentation. So we'll stop sharing this. Hope you learned something there. Next video is going to be involving some homework problems. Thank you.